Bookkeeping is the systematic recording of financial transactions for a business. In this narration, we will discuss, define, and explain the main types of bookkeeping transactions you will encounter. Understanding these categories helps ensure accurate records and reliable financial statements. First, a bookkeeping transaction is any event that affects a company's financial position and can be measured in monetary terms. Transactions are recorded as journal entries that record debits and credits under the double entry system, or as single entries in simpler cash accounting. There are 5 primary transaction types in traditional bookkeeping: assets, liabilities, equity, revenues, and expenses. Asset transactions increase or decrease resources owned by the business, such as cash, inventory, equipment, and accounts receivable. Liability transactions change obligations the business must pay, like loans, accounts payable, and accrued expenses. Equity transactions affect owner claims and contributions, including capital injections, owner withdrawals, and retained earnings adjustments. Revenue transactions record income earned from sales of goods or services. They increase equity through net income. Expense transactions record costs incurred to operate the business, such as rent, utilities, wages, and cost of goods sold. Expenses decrease equity when recognized. Beyond these core categories, there are several other transaction types bookkeepers must manage. Contra transactions reduce the value of related accounts. For example, accumulated depreciation reduces the book value of assets. Adjusting entries are made at period end to recognize revenues and expenses in the correct period, including depreciation, accruals, and deferrals. Accrual transactions record revenues earned or expenses incurred before cash changes hands, while cash transactions record actual cash receipts and payments. Compound transactions affect more than 2 accounts in a single journal entry, requiring careful allocation among accounts. Non-cash transactions involve barter, stock-based compensation, or asset transfers recorded without immediate cash flow. Correcting entries fix errors discovered after initial posting. Finally, source documents like invoices, receipts, bank statements, and contracts provide evidence for every transaction, supporting audit trails and compliance. Consistent classification and timely recording of these varied transaction types keeps financial data accurate and meaningful. By recognizing each type, assets, liabilities, equity, revenue, expense, and the related special entries, bookkeepers can maintain clarity, support decision-making, and produce trustworthy financial reports. Regular review, reconciliations, and adherence to accounting policies ensure these transactions are recorded consistently, reduce errors, improve forecasting accuracy, and provide stakeholders with dependable information for planning, compliance, and evaluating business performance over time and supporting long-term strategic goals worldwide.